Hello and welcome to Tax Matters. This past week witnessed a combination of tsunami and earthquake rolled into one in the taxation space in Nigeria, and that's talking about the earth-shaking but nonetheless heartwarming news emanating from the presidency, which seems to be taking revenue matters in particular and the economy in general as its main focus. On Thursday, 6th of July, the presidency announced the signing by President Bola Ahmed Tinubu of 4 executive orders.
His Excellency President Bola Ahmed Tinubu promised to address business-unfriendly fiscal policy measures and multiplicity of taxes. Consequently, President Bola Tinubu, in fidelity to the pledge to put Nigerians at the center of government policies, has signed the following executive orders. Executive Order 1, the Finance Act Effective Date Variation Order 2023 has now deferred the commencement date of the changes contained in the Act from May 28, 2023 to September 1, 2023. This is to ensure adherence to the 90 days minimum advance notice for tax changes as contained in the 2017 National Tax Policy. Executive Order 2, the Customs Excise Tariff Variation Amendment Order 2023. This has also shifted the commencement date of the tax changes from March 27, 2023 to August 1, 2023, and also in line with the National Tax Policy. Order 3, the President has given an order suspending the 5% tax on telecommunication services as well as the excise duties escalation on locally manufactured goods. 4, further to his commitment to creating a business-friendly environment, the President has ordered the suspension of the newly introduced green tax by way of excise tax on single-use plastics, including plastic containers and bottles. In addition, the President has ordered the suspension of import tax adjustment levy on certain categories of vehicles. Like I said earlier on, any vehicle of 2,000 capacity, engine capacity and above, which the tax was imposed upon, has now been suspended. So it means that for the meantime, in the interim, the tax imposed on any vehicle of 2,000 cc and above is now suspended.
There you are. Yes, Finance Act 2023 has become law, but the measures, the provisions contained therein will now, as things stand today, commence of September 1st, 2023. And talking about the provisions, we have been taking you through them under the guidance of Mr. Albert Folorunsho. You'll recall that we did tell you in that episode that a total of 7 tax laws were amended. For example, the rate of tertiary education tax has moved from 2.5% to 3%. Before we move on, and still from that press briefing, this interesting one.
Our aim is not to tax production. Our aim is to increase our productive activity, capacity to produce. Then we can tax our consumption. And that is the direction of our economic planning. And then we want to increase the trust that we have in government. And if you observe what has happened in the last few days, the last few months that we've been here, we've kept to our word. Part of what we are doing today, just to increase this trust that we are here to do what is the best for the country.
Taxing consumption rather than production. Commendable, very commendable. And we must say that this is in tandem with the stand of the current leadership at the FRS, where greater emphasis is placed on indirect taxes over and above direct taxes like value-added tax, electronic money transfer levy, stamp duty. Nigeria is on the right track. As if the release of the 4 executive orders was not enough for 1 week, the very following day, Friday, 7th of July, news again came out, yet again from the presidency, of the empaneling of a committee the Presidential Committee on Fiscal Policy and Tax Reforms. The committee is to be headed by Mr. Taiwo Oyedele, Fiscal Policy Partner and Africa Tax Lead at PwC, a very good friend of this program. Mr. Oyedele's last outing on tax matters was the interview in which we got his perspectives on Nigeria's new tax to GDP ratio. We await further details with respect to other members of the committee. Our interest, however, on tax matters is with regards to whether this committee is a study group. There was a practice in the past wherein every decade a study group was empaneled to review the tax and revenue system in Nigeria. In this regard, we remember the Shehu Musa study group. In 1978, a task force on tax administration headed by Alhaji Shehu Musa was set up by the federal government and achieved, among other things, the introduction of withholding tax in the Nigerian tax system. In 1991, a study group on the Nigerian tax system and administration, headed by Professor Emmanuel Edozien, was set up to review the tax system and make appropriate recommendations. A year later, in 1992, a study group on indirect taxation, headed by Dr. Sylvester Ugo, was set up by the government, and they achieved the following: the establishment of the Federal Inland Revenue Service, the establishment of the revenue services at the three tiers of government: indirect or consumption tax, that is, value-added tax. That was the beginning of value-added tax in Nigeria. In 2002, a study group on the Nigerian tax system was set up under the headship of Professor Dotun Phillips of the Nigerian Institute for Social and Economic Research, NISA. Among other things, the Dotun Phillips study group recommended decentralization of the tax administration system, reduction in tax rates, and the development of a tax policy for Nigeria. The report of the study group, submitted in 2003, contained some other radical shifts in policy. This necessitated the federal government setting up a working group headed by Mr. Sheyi Bikeset to review the report of the study group. The working group, which concluded their review in March 2004, agreed with some of the suggestions of the study group and disagreed with some of these suggestions. The implementation of the critical changes in the laws and institutions governing taxation and tax administration marked a new era in the history of both the legal and institutional processes of tax administration in Nigeria, bringing into place the modernization and reform practices which had never been attempted in the history of taxation in Nigeria. The reforms include organizational reforms in refunding, legislation, taxpayer education, dispute resolution mechanism, taxpayer registration, human capacity building, and automation of key processes, refund mechanism, and several other areas. Unfortunately, the tradition of empaneling a study group every decade was jettisoned, but thanks to the President Tinubu administration, things are looking up. So we ask, is the Taiwo Oyedele Committee the long-awaited study group?
I'm a very busy man. My business involves a lot of traveling and I interface with lots and lots of people and organizations. Tax compliance used to be a big drag on my business. It was time-consuming and very costly. But now, no more. Introducing the FIRS TaxPro Max, the truly fully end-to-end tax administration solution for companies' income tax, value-added tax, petroleum profits tax, and all other tax types. For fast, efficient, and convenient end-to-end tax experience, log on to www.taxpromax.firs.gov.ng. TaxPro Max has turned things around for me. It is fast, user-friendly, and cost-effective. FIRS, making tax administration as easy as ABC.
Thank you for staying with us. As we said in the introduction, the Finance Act is law, even as the commencement date is now September 1st, 2023. Our next story is a summary of proceedings of a webinar hosted by the FRS on the Finance Act 2023. What are the highlights? What are the provisions? Take a listen.
Over the years, the Finance Act has been introduced to amend relevant tax laws, exercise and duties in accordance with macroeconomic policy reforms of the federal government, and also to amend or make further provisions and clarification in specific laws in connection with the public financial management of the Federation. The Federal Inland Revenue Service, under the leadership of the Executive Chairman, FIRS, Muhammad Nami, operates with 4 cardinal objectives, one of which is to position the service to be a customer-centric institution. Central to achieving this cardinal objective is continuous taxpayer engagement and enlightenment through various channels, such as the webinar series we are holding today.
We intend to discuss a document that is already in the public place with tax consultants, taxpayers, and other critical stakeholders, so that we will get to have feedback and comment from them on the provisions that were amended by the Finance Act, which ordinarily should have been Finance Act for 2022, but for former president's inability to sign the initial one that was passed into law in December 2022, which was eventually returned for some concern and returned to National Assembly for certain amendment, and was finally ready for his signature on 26th, and he signed on the 28th of May 2023, meaning that the Finance Act that ordinarily should have been Finance Act for 2022 is now Finance Act 2023.
Mr. Matthew Osaneku gave an overview of the Finance Act 2023. He began with this backgrounder.
We'll be quickly looking at the review of Finance Act 2023. The Finance Act is a fiscal document initiated by the Federal Ministry of Finance, Budget and National Planning, and is prepared along with the annual national budget in order to facilitate a quick and focused amendment of various fiscal legislation for effective and efficient operation of yearly budget, and also to address other fiscal policy reforms. Key objectives of Finance Act are as follows. One is to raise revenue for the government, also to promote fiscal equity, implementing the recommendation of national tax policy, also simplification of complex and ambiguous provisions of the tax laws, blocking of loopholes in the tax legislation, also to abrogate obsolete provisions of the tax laws to align with current realities. Prior to the enactment of any Finance Act each year, the Minister of Finance, Budget and National Planning will roll out a policy direction. The tax system is anchored on 3 tripods: tax policy, tax law, and tax administration. And the policy direction that was rolled out in December 2022, that was approved by the Federal Executive Council, highlighted 5 thematic areas for consideration. Now, let's quickly roll down with all the key amendments. Now, the capital gain tax, section 3, was amended to include digital asset as part of chargeable asset. Section 5 introduced of claim of capital loss against capital gains. Section 31 included stocks and shares are classified for the purpose of rollover relief. Now, section 14 also introduced a provision that requires the service to request for evidence of filing of tax returns and PCT from shipping and online companies. Now, section 32, 34, 37 that speak to investment allowance, rural investment allowance, and income earned on convertible currency are now deleted. Now, second schedule also introduced the midstream gas operation to enjoy no restriction for the purpose of capital allowance. Now, PIT, Section 33 was amended, and the fund annuity is now deductible. For the petroleum profit tax, Section 2 included a provision and interpretation of the commission, the MUPRC, and defined the commission to replace NMPC. Section 10 of PPTA also introduced rules for the commissioning and abandonment. Section 23 also provides the duties and functions of the commission, and one of them is to determine fiscal oil price. Section 30 introduced actual filing regime in PPT, and Section 53 also introduced new penalty regime for PPTA. Stamp duty Section 18A was amended and introduced new sharing formula of electronic money transfer levy. Education tax also was amended. A new rate of ET was introduced. VAT was also amended. Section 7 introduced adjustment to artificial and fictitious transaction for VAT. Section 14 also introduced new date for remittance by appointed agents. Section 16 of VAT Act also introduced new rules for taxable goods purchased online. Section 46 also introduced new definition for buildings.
Next is a summary of the amendments to the Companies Income Tax Act in the Finance Act 2023.
In this Finance Act 2023, there were 8 amendments that relates to the Companies Income Tax Act. And I start with the first one. The first amendment is contained in Section 14 of the Companies Income Tax Act. Section 14 of that act relates to the taxation of companies engaged in shipping or air transport. The section was amended by introducing a new subsection 4A. And that subsection 4A provides that non-taxpayers shall file income tax returns containing a certified gross revenue statement of its Nigerian operations. Under subsection 3 and 4 of the existing law, which require that the taxpayer is subject to tax using the adjusted profit ratio and a depreciation ratio. And in using that, one of the information that is required is the turnover or the revenue that is generated from Nigeria. So what the law, the new introduction or the new insertion into the law is saying now is that when you are filing your returns under that section, either for the purpose of the adjusted profit ratio and depreciation ratio, or for the purpose of the application of reasonable percentage under the next subsection, the taxpayer is expected to file his detailed gross revenue statement of his Nigerian operation. And that detailed information must show the full sums that is earned in Nigeria and must be supported by all invoices issued to their customers. And that statement must be certified by the company's external auditor and one of his directors. Then we have the section 14C6. A new subsection 6 has also been introduced, which requires that any company in that sector that is engaged in shipping or air transport, that is foreign companies now, when they seek approval or permits relating to their operation, they must provide evidence of returns filing, evidence that they have filed their tax returns, and they must also provide TCC. And this is a prerequisite for them processing approvals and permits from any regulatory agencies. What this means is that NEMASA, Nigerian Civil Aviation Authority, probably FAN, and the Nigerian Port Authority, as many that provide form of approvals or permits to these airlines and shipping companies, they must request from those companies evidence that they have filed their income tax returns, and they must also request for tax clearance certificate that has been issued by the Federal Inland Revenue Service. The next amendment is in section 32 of CITA, which is on reconstruction investment allowance. Prior to now, we have provision under Section 32 that gives 10% reconstruction investment allowance on qualifying plants and equipment. Now, in the Finance Act 2023, that section has been deleted. The question may be asked, what about those that have incurred? And before they could claim, this law has come out providing for the deletion. The section that provides for the deletion clarify that for those that have incurred that expense or that qualifying plant and equipment expenditure, they will be allowed to claim in respect of that previous expenses that have been incurred. But we shouldn't forget that it is claimable only once. So those that have incurred, they are allowed to claim it only once in the year of use. And if it cannot be claimed in the year of use, then it will lapse. We also have Section 34, which is on rural investment allowance. That same Section 34 has also been deleted through the Finance Act 2023. Another question is, what about those that have incurred that expenses before the effective date of this Finance Act? The provision provided for that deletion allow them to claim for those that have incurred, not those that will incur subsequently, but those that have incurred have not claimed. The law allowed them to make that claim. I also need to clarify that this is also available only once in the year of use. Any company that is unable to claim it in the year of use, it also lapses. That is the provision of the law that have now been deleted. We have Section 37, which is in respect of incomes in convertible currencies. That Section 37 has also been deleted, but prior to this deletion, that section provide that 25% of incomes in convertible currencies derived from tourists by hotel is exempt from tax, provided that the income is placed in a reserve fund for expansion and it is utilized within 5 years. So now this provision has been repealed. But what happens to those that have complied with the previous conditions? That is, they have set out that income and they have put it in a reserve fund. What happens to them? This new amendment that provides for deletion allows them, for those that have provided those funds in that reserve fund, they will be allowed or they will enjoy that exemption until the money they have provided is fully utilized. But we shouldn't forget, it said it must be utilized within 5 years. So if they are unable to utilize it within that 5 years, it will also lapse under the existing rule. But if, for instance, they have utilized it for 2 years, we have only 3 years left. It's only 3 years that is left that they will allow to claim the exemption. We also have amendment to the second schedule of CETA, which is on capital allowances. Paragraph 18 of second schedule. Paragraph 18 is the paragraph that deals with leases on the books of claims of allowance by lessee. And in that section, in that paragraph, so paragraph 3, provide for investment allowance in respect of capital expenditure on plant and machinery, while subparagraph 7 provide for investment allowance in respect of capital expenditure on agricultural plants and equipment. In order to align this provision with Section 32 that have been deleted, these 3 subparagraphs has also been deleted. So it is not only the investment allowance under Section 32 that is deleted, all the relevant provision also in subparagraph 3 and 7 of paragraph 18 has also been deleted. So that 10% investment allowance will no longer be available for claim. Then we have amendment to the second schedule of CETA, which is paragraph 24. And this paragraph introduced unrestricted capital allowance for capital expenditure used for upstream and midstream gas operations. Prior to now, we have that subparagraph 7 of paragraph 22 that restricts capital allowance to 66 2/3. Capital allowance under that subparagraph is restricted to 62 2/3. But some special industry or some companies engaged in some industry, theirs are not restricted. And those industry then were agro-allied industry and manufacturing, those engaged in agro-allied industry and those engaged in the business of manufacturing. Now, 2 other industries has been added, which is those engaged in upstream and those engaged in midstream gas operation. So what it means is that their capital allowance will not be restricted under subparagraph 7 of paragraph 24.
Finance Act 2023, there for you. Thank you for watching. See you next week.